Not everyone is a seller of software. Our next guest sees bargains in the space and says the AI scare narrative is not tied to reality. Gil Luria is the head of technology research at Davidson and is out with a note today on software valuations. Gil, great to have you with us. I take it that you heard Carter's analysis of the space. It's not a very rosy picture in terms of performance past or performance future. So why do you think this group, what are the fundamentals that will drive this group higher when they've seen such underperformance for the past 5 years?
Yeah, the simple reality that software businesses are still the best type of businesses. They are recurring revenue businesses that scale well at very high incremental margins. None of that has changed. The good news is we used to talk about software companies as a multiple of revenue, and who can really tell the difference between 6 times revenue or 8 times revenue? We don't have to do that anymore. We have great software business growing double digits, 20% and higher, that are now trading in the teens on cash flow, on the 20s on cash flow. Those are attractive price points. And we don't have to fight Carter's charts. We're not calling a bottom on all of software. We're just being selective about the stocks that are doing so well, the companies that are doing so well, and their stocks keep going down every day, that we believe that if we continue to buy those, there will be a re-rating once this wave of negativity is over. Because again, there has been no AI impact on any of these companies. AI has not disrupted or dislocated any software company. And if it doesn't do it this year, at some point we're going to scratch our heads and say, isn't AI just a disruptive technology that good companies are going to adapt well to and bad companies are not going to adapt well to? So if we buy the good ones, they're going to do well.
All right, Gil, so Adobe made its all-time high in, I think, the fall of 2021. Think about that for a second and think what the market's done in the meantime. And we're trading the levels that we last saw in the fall of 2022. What's the bull case here, other than the fact that technically we're hitting what should be support, and you can make a decent case on valuation?
So the bull case on Adobe is for all of the negativity around AI, Adobe's growth has actually held up better than the overall software universe. Their growth has decelerated from maybe 12% to 11% or 10% over the last 3 years, which is to say that really strong recurring revenue business that's embedded in every marketing organization and every agency has held up really well. And to your point, the stock has not. It's now trading at low teens multiples on earnings and cash flow. If they just keep doing what they're doing, which is grow 10% this year, then it's not going to be sustainable that their stock will continue to be this inexpensive. Which isn't to call for a catalyst here. They're just going to keep doing what they're doing. It's the narrative that's been very negative about Adobe, again, without evidence. They haven't lost any business to AI, nor does it look like they're going to lose business to AI this year.
What's your take on the Oracle, the bondholders' lawsuit with Oracle? They allege that, there might have been malfeasance. Maybe there should have been more disclosure at the very least, because they bought these bonds in September, and then several weeks later, Oracle went out to raise another $38 billion, and they feel cheated. Is this going to be an overhang as companies go again and again to the debt market to finance?
Yeah, Oracle overextended itself for OpenAI. OpenAI promised them the moon, and then Oracle realized that OpenAI actually had promised everybody else the moon as well. And then they overborrowed to build infrastructure. They're now at the very bottom. They're approaching the bottom rungs of investment grade. They're approaching the ceiling of debt ratio, and yet they need to borrow more in order to deliver on these commitments. So they've put themselves in a real bind. The stock's gone down a lot. Their debt is trading at a discount, and it's not too surprising that recent debt holders feel like this isn't what they bargained for when they bought the bonds a few months ago.